for my trade to be short term. That was yesterday. I see that I will look at this opening bell. Pre-market levels, I see 555 once again to the upside, which we did kind of stretch towards yesterday. That was also a gamma level that I was trying to reach. I had a long 555 call yesterday. I paid 47 cents for it, ended up closing 97 cents yesterday as we got near the highs towards the day. That was a pretty easy trade. I just got it up to around 65 cents or so, put my stop loss to break even, just watched it, monitored it. It's up to 75, 80 cents, 85 cents, 90 cents, started locking in some profit. Nearly or just over 100% gain on the return on capital. So not too bad. 555 is that level that I'd be watching. Today it looks a little bit lighter though. Yesterday this was like 1200 net on the gamma level. Today it's 303. Oh, it could still be hit. It's kind of the only real level that I see out there. But if we gap down to 550 or 551, we're gonna have a nice little $4 move on the SPY today. So pre-market, watching, noting that level. I don't really see a lot to the downside. Once we hit opening bell, I'll look to see if we have any levels that are lighting up one way or the other for maybe a 0DT trade this morning. Overall, it's been a pretty fantastic couple of weeks since we had our low August 5th. I sent out a video yesterday through the Trading View I posted on YouTube and Twitter. Are we going to see this level, which was the big sell-off point that we had on the 1st of August? Is this level going to be some type of kind of measured move and maybe some profit taking as we wrap up the week? It's very possible. This week was pretty incredibly bullish. Let me open up my editor here. And if you were a futures trader, Monday was pretty choppy as a futures trader. It didn't really give us a lot outside of some chop, which was totally fine for me for some of the daily trades that I take. Monday was profitable, Tuesday was profitable, Wednesday was profitable, Thursday was profitable, not just with my daily strangle trades, but also with my little long position I took on Thursday. Ended up, like I said, about 100% return on capital. I've had a nice P&L swing the last couple of weeks as well. Volatility, I want to say that volatility has in fact done another kind of record move, which is one of the biggest moves we've seen 3 times in history where we had the volatility index over 50. I think only the 5th time in history we've seen it over 35, and that spike up to 65 was the 3rd highest ever. But one of the largest single day moves. I think it was the 2nd largest single day move in VIX history. And then we also had one of the fastest declines, going from 65 peak all the way back down to I think 15 yesterday. So the volatility index, just a crazy move. And the data was just pretty perfect this entire stretch for the last couple of weeks because, the market put on that quick panic and all of a sudden, data started to fall in line, which was unemployment claims are lower than expected, and PPI was softer than expected, and CPI was softer than expected. Let me bring up a couple of things here to show what we're talking about. So if you checked out my video yesterday, I did highlight a couple of these things. So let's go to, let's see where we're at on the yield curve, by the way. The 10 and the 2, I'm going to take a look at those really quickly. The 2 years at 4.04, the 10 years at 3.88, that actually separated a little bit more. Now we have about 16 basis points away from each other, so we're still inverted. Rates have gone up slightly. The 30-year was at 6.47, now it's at 6.49. Bonds are down this morning. Looks like yields are down. We'll see what happens during opening bell. Mag 7 hanging in there. I took a trade off yesterday on Tesla. I had a ratio spread that I think expired. Let me double check that expiration. I'm going to log into my Tasty platform. So let's go to a couple things here. I was looking at the inverted yield curve. Let's go to inflation data year over year. So the print this week on Wednesday was 2.9. So if the market is excited about this, all that is that we've actually had a decent trend for the last couple of months, right? So July's print, June, May, April, March, right? So we have had trending inflation the last 1, 2, 3, 4, 5 prints from a high, or I should say a sticky high around 3.5, 3.4, 3, 0, and 2.9. So the trend has been solid the last 5 months. I still think the problem is we haven't really made a huge improvement since July of last year. We obviously had a big drop from 9.1% all the way down to 3%, but we have been sticky in there. And even with the Fed looking to cut rates and only cut rates by 25 basis points in September, um, you have to wonder, like, how dovish are they going to say they're going to be to the market? The market's probably ready to run with it already. Just the hint of cutting, and likely the Fed's going to, once they start cutting, they're likely going to stay that way. But you have to wonder, will this Fed regime be able to prevent a second wave of inflation? Historically, when we've had high inflation in the U.S., we've always had a second wave of it. And I do think that potentially whoever steps in for president, and whoever sweeps administration wise, fiscal spending is likely going to happen. I do think this is still a huge issue that is going on in the U.S. that we can't ignore. I listened to an interesting podcast yesterday with a couple of financial planners. They were talking about the fiscal deficit, or our U.S. global debt, or I should say U.S. debt and global debt on top of that. But U.S. debt is probably one of the largest problems that we're not dealing with. Politicians don't want to deal with it because if you're, promoting austerity, you're not going to get elected. And we can always just print more money. We can always kick the can down the road. We can always delay. We can always, it doesn't affect us right now. It's something down the road. But historically, our, percent debt to GDP, our spending compared to our GDP, it just continues to go up, and the numbers continue to rise. I have a screenshot. Let me read off a couple of ridiculous statistics. Let's see here. So screenshots. Usually when I listen to these podcasts, I like to take some screenshots. So we have the federal government interest payments as a percent of nominal GDP. This is one. So we're at the highest. I'll repeat that. Federal government interest payments as a percent of nominal GDP. This is from 1947 to 2024. So a lot of history here. We're at 3.8% interest payments as a percentage of nominal GDP, the highest that we've ever been back in the 80s, back in the 90s, around 5%. We're at 3.8. That might seem like, well, we're not at 5% yet. We're not, but this is the highest level since 1998. So not a good thing. Our interest expense has gone up. Now we're looking to spend over $1.1 trillion on just our interest expense for our current debt. What's also staggering is the percentage GDP is 27%. It's crazy high. And since, let's see here, this is insane. We've seen a $3.6 trillion increase since June of 2023. We lifted the debt ceiling. We've added $3.6 trillion to our freaking debt. Like, you could call that irresponsible, But like I said, it's not a popular topic. Nobody in U.S. politics is talking about it because it's a terrible thing that, we don't want to deal with or confront. But the reality is, ultimately, this could be, how the U.S. struggles. I'm not going to say collapses, and I'm not going to say fall apart, because it's not like the U.S. is the worst off country and, we don't have huge growth potential as well, but it's still a problem. And could this lead to, lagging in the global economy? Sure, yes. But my job is not to get all doomsday and preppy and stuff like that. It's just, it's going to be something we have to deal with. So anyway, news is all exciting. I know the market's, ripping back here the last couple weeks. I'm just looking to see how sustainable this run is. This culture of buy the dip and sell the rip. Buy the dip certainly has been very, very profitable the last couple weeks after what a crazy event we had on August 5th. Which a lot of things just happened. It was a big unwinding for leverage because it was two parts, right? I mean, if you looked at the movement in the Japanese yens, we talked about the Nikkei dump. This was one of the largest largest 2-day events we ever had in the Nikkei. By the way, Nikkei and Japanese yen, let's look at currency strength overnight. Currency strength overnight, we're seeing JPY creep its little head up there. That volatility is not quiet. So a little bit of a risk off tone today. We'll take a look at our Japanese yen crosses. So we're good on the inflation stuff. I do see this trend the last 5 months, which I think the market is enjoying, but we really haven't made any huge improvements since July of last year. Fed's still likely going to cut. There is a softening labor market. We're going to see if the consumer is going to scale back a little bit. Retail sales that we saw this week suggest otherwise. If we look at labor market data, go to non-farm payroll, we had the huge miss on August 2nd. That was our forecast at 176, came in 114. Again, jobs numbers from really February of this year have been lower. Now, yes, we've had positive prints. We haven't had a negative print non-farm, but way, way lower job prints. and we've had 2 misses. Let's start back here in February. That was a positive, that was a positive, that was a positive, that was a miss, that was a positive, that was a positive, that was a miss. So for the most part, we have beat expectations, but again, notice the trend. Trend is lower. Okay. I don't see that as a great sign. We're still going to get another round of non-farm data before we have the FOMC in September. If we look at unemployment claims, this has been pretty steady. Another thing that the market liked these last 2 weeks is this comes out every Thursday. The market forecasted and came in softer. So market liked it. Market liked it. So unemployment claims, the triggered SOM rule, where the 3% or the 3 month unemployment rate, or the rise in the unemployment rate in the 3 month trend, is 0.5% greater than the 12-month low. So whether that sounds complicated or not, it's been an undefeated indicator of a recession, and we're going to continue to monitor this and see how sensitive the data continues to be. Another thing with the what also has a pretty good track record has been the inverted yield curve. We go inverted, we stay inverted, but by the time we come out of that inversion, that's not a good sign for the markets, because if we go into the yield curve, let me go into anything else here. So unemployment rate, we've seen this also trickling higher. Going back to January of 2023, we've increased nearly 1% over the last year and a half. So 0.7%, 0.9%, those are also terrible signs historically for having recessions. And I mean, I guess just like we saw back in 2022, nobody really talked about this, but 2022 was a pretty massive downturn in the market. We had 25+% off the highs of the S&P. We had 35+% off the highs of the NASDAQ. That was a rolling bear market. Now, at some point during that year, it felt like there's nowhere to hide and everything kind of pulled off. But we also had like different sectors that were okay. Early in the year, we had energy that was pretty solid. We had pro-inflation the first half of the year that did really well, and then everything kind of sucked the second half of the year. But there was stability in there somewhere. So what I don't think we've had since, we'll say, 2022 is we haven't had a full-on broad market sell-off. Now, yes, we had the dip and the volatility event, but if you look at every sector, what happened? We just had a big deleveraging. And then as soon as we had an opportunity to buy or open up, and the market's like, okay, that's enough, 10% and 15%, 10% down on the SPY, 15+% on the Qs. The futures market for the NASDAQ was down almost 20%. But it was just an immediate buying spree, which, again, commendable. But is it sustainable? I'm not sure. But we see a rise in unemployment. Okay, our wage growth also trending lower. So, I mean, the reality is here, this is not painting a super rosy picture. I know the unemployment claims have allowed the market to recover, but I still look at this overall chart with a little bit of like, I'm scratching my head here. The video I did yesterday, I probably said this is crazy maybe a dozen times, because this is a little bit nuts what just happened here the last couple weeks. So I would be, and I asked this yesterday in one of my live sessions, are we going to, retest the high or retest the low? I just threw that out there as a random poll. Like, what do you think's going to happen? Are we going to retest the high or retest the low? And I mean, most traders said the top, which makes sense. And if we hold here, and we don't turn back too sharply, then we can have a little bit of a breather. We've had pretty much nonstop buying since the low on August 5th. But if we pull back, I mean, we do have some gaps to fill here. We can see those pretty easily if we go down to a smaller time frame. But if we pull back to, this is the SPY, so we pull back, let's say, to 545. Look at the futures feed. If we pull back and just take, we've had a fib here, we pulled back around 70%. Who remembers? I don't know if it was this week on Monday or if it was last week during some of my live sessions. Does anybody remember me talking about the 70% pullback zone? Okay. Because if we pull back 70%, that's also the anatomy of a wedge. So a high to low, pull back here 70%, we go down and form a higher low, and then a lower high, and then a higher low, and then we're looking at this type of behavior. And guess what has to happen? The market's going to make a decision from there, right? So are we about to see some quieter times, maybe some choppiness, right? Maybe some. I mean, there's plenty of opportunity for some volatility moves. But if things kind of quiet down here the next couple of weeks as we finish up August, get into September, maybe it's I don't know. I don't want to say it's going to be quiet, because volatility just went from crazy rips all the way back down to 15. If volatility pokes up into the 20s again, you got to wonder what that looks like on the stock market, right? So, anywho, that's what I'm watching. I could see the 70% leading to a wedge. I'm not getting super bearish. I mean, this was a pretty pronounced rip to the upside. We are testing that that August 1st high. So if we pull back at all, okay, fine. I mean, I'm gonna have to. Hang on a second. I'm gonna have to see some price action. Support. I mean, if I look at this chart on the E-mini futures feed for the S&P, I would say that the bears would have to take out 5,400. Okay. We'd also, look at a trend line here or look at a more aggressive trend line. I'm not really going to be bearish on this first trend line, so I'll delete that one. But I would say that if we come back in and take out these lows around 54 to 54.50, then these bears look like they are, trying to make a move, right? And how many times have we seen a topping pattern? I mean, if you're a forex trader, a technical trader, if you see a high to low pullback, lower low pullback, that's a perfect sign right there. Have resistance and wave structure, and we actually do make new lows. So it's very possible that all this is a test of this high right here, and the market starts to sell off. So again, am I turning bearish? Not necessarily. I'm short term, looking to trade indexes and get some volatility plays. I will keep an eye to see. I mean, if we can somehow stretch to 555 today, opening bells in about 8 minutes, then I probably have a trade on I've got a couple of vol plays. One I took profit on this week. One is out to the end of September, so I'm willing to give it some time, but I'm looking for price to go somewhere between 553 or higher or 518 or lower. And that gives me a little bit of area to play with on the SPY. So I'm watching, okay? NDX, same type of thing here. NDX, if we take out these lows, let me use a straight line. If we take out these lows here, this would be around 18.8 or 18.75. We're up to 19.5 almost, which is again a crazy run coming back to test this level. Again, August 1st high. We do have some gaps to possibly fill. If we're gonna stall a little bit, I could see some indecision from this 19.5 bound down to like 18.8. I do have a trade out to the end of the month that if we get back below 19.1, that's a nice little hedge that I have a 19.2 by 19.1 bear put spread on NDX. It's actually on the NQ. We're trading at 19.483 on the NQ, starting to turn back a little bit. This bear trap is in the box here at 19.1. If price is below it, I get full profit. My bear trap actually starts at 19.2, but I think I paid maybe $15 or $20 for it. So I want to see if I can get that, net $75 to $80 of credit if it gets back below 19.1. The Dow pre-market down about 80 cents. This is the closest index to the all-time highs. Again, are we going to make all-time highs with the Dow when the NASDAQ and the SPY are still not making highs? Not sure yet. The Russell had a nice little rip to the upside. We've come off this. I mean, this is a pretty wild and volatile index for small caps right now. We had this great breakout to the upside, record-breaking call option volume on the Russell, and then just gave it all back. I mean, that was a huge blow to what I was hoping for would be a test of the all-time highs. And I'm not saying that we can't get there, but it looks like it's no longer the explosive kind of ascending wedge breakout bull flag that I was thinking this looks pretty promising to go retest the highs. I mean, we could possibly still do that, but coming from this type of reset and then pulling back, I could see price coming right back into all this support level. Let's say 200 on the IWM. If it just kind of gently works its way higher, that's fine, and maybe we have a reversal pattern there. And there's a neckline, and we still justify a gain. I can measure a move here towards 240 or 245. But again, price has to prove it. So I think the bulls have their work cut out for them on small caps. It would make sense if we have a high and we have a low that this stays somewhat choppy in between. So watching those levels carefully. I do have a couple expirations out on the RUT, which I can hopefully pin some prices here at 2050 and 2100 for some nice profit. The VIX all the way back down to 15.6. We're going to see if this gets somewhat elevated, maybe a pop back up into the high teens or 20s, might get the Japanese yen a little bit strength, give the Japanese yen some strength, maybe give the index a little bit of a pullback. This is another, kind of short-term volatility play. When the VIX spiked up, I was looking to buy the SVXY. Frank, with A1 was buying the SVIX, which was a great trade. I bought that thing at like $23. The DXY, let's talk dollar. Hey, what do you know? More choppiness from the dollar. Okay, so are we getting closer to a full-on breakout of the dollar to the downside. Watch this area closely. If you're trading currencies, watch this dollar index closely. If we take out this low with a daily or weekly close, I'm looking for this to be something that we can fade and actually have a breakout post-summer trading. If we get a breakout below 102, the dollar getting sacrificed to the downside is probably a good thing for the overall stock market. Okay. The Fed is likely going to be cutting rates in September. And we've kind of squashed the idea of, 50 basis points, 75 basis points, having an emergency cut from the Fed. Doesn't look to be the case. Right now, the probability is pretty steady. It was 76 yesterday. Now it's 72 today. There's going to be a 25 basis points cut, right? Now, the question is, are we going to cut in November? Market says yes by 60%. We're going to cut in December. Market says yes. Okay. So if we go to 5, go to 4.75, and go to 4.5, 4.25, the market's suggesting that yes, we are cutting 1, 2, 3 times through this year by 25 basis points each. December is still a 50-50. Maybe they go 50 basis points in December, which, again, Fed's going to do whatever it wants to do. But looks like right now the probability is that there will be cuts coming by the end of the year and cutting through next year as well. Now, I don't know if every meeting that they have is going to be a cut, but this lines up to something like 2 to 2.5% of lower interest rates moving forward. So by the end of September, this is forecasting a 3.0% or a 3.25% low end of our Fed window, our cash window. So what does that change? Well, if the Fed can somehow thread the needle and navigate this soft landing and not have inflation spike back up, especially going through next year, everything looks good for right now. We've got an election year. I mean, I think the market's just going to put blinders on and probably grind to the best of its ability. But going into next year, things could be very different. It's a new year. It's a clean slate. We could have a whole new batch of problems. We could have escalated tensions. We could have all sorts of weird stuff happening that we're going to have to brace for and get ready for and navigate. But as it stands right now, it's like we're going to be probably 2% lower with our official cash rates, which does help some big finance decisions out there in the U.S. You want to buy a car, cars are cheaper, and financing could be cheaper. You want to buy a house, houses probably aren't going to change a lot in prices as far as coming down, but interest rates going lower could help motivate people to either list and sell or motivate people to jump out there and actually look to buy with some of the supply that's coming on the market. So anyway, a lot of stuff to digest there, but going back to the currencies and the dollar, I have said that if the dollar gets weaker, I think that's going to be something that helps keep some risk appetite in the markets. To me, that dollar breakout is going to be with this wedge pattern. So I'm going to go ahead and get rid of this line right here because that's not doing any good. If we get a breakout from this previous low, which is right around 102.20, check this low to the pip. That is a low of 102.16. 102.16. So I have a chart alarm set 102.12 right below those lows. I will be looking for a daily or weekly close beyond that. And if that is the case, my first target is going to be 101. And if we go beyond that, okay, let's just measure symmetry for a moment. If we go from a high to low right here, so take this high to low swing, and I would be projecting a lower high to lower low swing. So that gets us down towards 94. That's a big, ridiculous bear move on the dollar. I don't think it's going to come in one straight line, but you never know. But if you look at this from a swing, it's like we could get down to this level here and then use this structure as support becoming resistance. So if we make a meaningful break, I would say the important thing here is not only do we break 102, but we also make a break below 101. See why I'm saying that? Because if we bounce, if we just break here, if we break here and then pull back from this 101 support, then this is now, instead of a wedge, this is a false move. Call that a prairie dog, call that a turtle head, whatever you want to call it. It could pull back to 105 again, and this structure still stays somewhat indecisive. And we're still going sideways on the dollar. If we can't break below 101, we're bouncing right back up. We're going to be a nasty little range again. But if we break below this 102.20 or 102.15 and also make a meaningful move below 101, now I think we can fade and fade and fade and fade. And we look at this area, maybe we get a pullback into that same low. This is support becomes resistance, and we finish this move towards symmetry and maybe this measure move here. Because we only pulled back about 38%, right? So it really is going to be something we'll continue to monitor. The nice thing about this is if we get this right, we have 5 or 6 currencies or 7 currencies we can trade to benefit from this. So I do like the idea of having a nice big trend in the dollar. Hopefully seeing the dollar go somewhere, and we'll go from there. So that's my thoughts on the dollar. Yen crosses. Let's take a look at those really quickly. Yen crosses. Let me get logged into my Tasty platform here. Opening bell just happened. We just gapped a little bit lower at 551. Let me see some opening bell gamma. So really quickly, a couple levels to note. I don't have large contract sizes, but my current net at 547. If we're going to see, a gap lower and a push lower, let me see something here. If I center this thing, I'm going to go SPX. Let's go Streamwise. All right, a couple things real quick. All right. So if I center SPX, and I'll go back to the yen crosses here in a moment. SPX at 55.30. Get logged into my platform. Okay. And let's check this one here on the SPX. I'll keep an eye on this one to see if we have any, if we just have some quiet movement today. Well, at least for the first like 30 to 60 minutes. If it's somewhat choppy and quiet between like 55.30, highs at 40, lows at 20. See if we get like just a small move on the day. Let me have a look. So I'm going to check and see what my P&L looks like. Up about $7,000 on the day, not too shabby. Let's go to SPX right here. I do have some profits rolling in today with some expirations. Let's go to 16th SPX for the day. 55.30, I'll center it right around there. Let's look at a 13 delta and a 14 delta. 85 to 65. Okay, so I get 330 in credit. Here's the trade that I'm going to take. So I'm selling the 55.70 and I'm selling the 54.85. So I'm going to add that into my tracker here. So 55.30, and that's a 54.85 buy. I'll actually do the calls first. 55.70 by 54.85. 335 credit. It's pretty solid, which means I'm going after probably 50 bucks on the day or close to it. So 3.35 times 0.15, 50 bucks on the day, 2.85. Let's go get it. All right, so see if that gives you some profit on the morning. Let me get this out of the way. Good stuff right there. Let's go copy that. So 55.30, 55.70. Okay, so sell 55.70 call, buy 55.90 call, sell 54.85 put, and 54.65 put. Yahtzee. Okay, there is that. Gamma levels again, just going to take a quick peek. So I do see this current net at 313. I did take, I took the gamma level towards 555 yesterday. As this was opening, that was getting really, really large at like 1,200 net. It got up to like 2,000 net, which is a big magnet to price. So even though we had a huge gap yesterday, the market just gravitated towards that level. It's still there, but way less convincing at 269. Now it looks like the downside pressure, 315 net on the 547 strike for the SPY. I'm not necessarily going to be shorting this today. It's been a good week. I'm not saying that I don't like the trade, but in case this chops around and doesn't really go anywhere, if I see kind of equidistant from like 555 to 547 and we just kind of stay in the middle. I mean, Fridays are typically directional days, but I don't know. I just want to see if it kind of chops around here for the first 30 to 60 minutes, grab some profit out of that strangle, and then move on. So I'll just keep an eye on this one this morning, but just keep an eye on this one. 555 is an upside target, and if we actually fade that move, this might take us into next week. But next week, 547 looks pretty doable. Okay. All right. Let's take a look at these yen crosses. So Aussie yen pulled back to around the 38250 zone. It's not quite at the 50. I still think if we have some risk appetite, right? Here's what we have to look for. If we go from low to high, if we get back and pull, let's say we pull back into like the 50 and 618 zone, we could absolutely see this high to low, rally up here, pull back, see if there's a higher low, and then the market gives us a recovery. Okay, could that also be a trade like this? Yep, that could be a great harmonic pattern to look to short on the yen crosses, trade it back to a harmonic merge, or maybe, see something worse where we have this future deleveraging. We saw something like, JP Morgan said, oh, the carry trade is about 70% unraveled. I mean, how they calculate that, I have no idea. But if we're not done yet for these Japanese yen trades, this is obviously a currency pair that I'm sure lots of FX traders are watching. I'm just looking at, okay, we've had a run to the 382. If we pull back for a higher low, we go back up into here, find some more equilibrium. The Japanese yen, for as crazy as it is, and as much as I hate trading it, it still sometimes can be like really obedient, even if it's crazy volatile. So from high to low, if we go up, pull back for a higher low, pull back into this level, we find that 50, we find that 618 zone, maybe have a harmonic trade, something like that. But I would be watching the Nikkei, I'd be watching the Japanese yen, looking at the currency strength and see what happens. Okay, so if I go down to we'll take a look at gold and silver here in a little bit. Copper is fine. 6J is Japanese yen, moving off these lows. Let me set a chart alarm here at 0.007. That's going to be fresh highs on the Japanese yen futures. I mean, obviously, if I'm watching yen crosses, that'd be yen crosses at fresh lows. The Nikkei actually had a huge day. Good Lord. So the Nikkei's pulled back from its 27% decline, about 61% of that move. Very impressive, of course. Now you got to wonder here, is this another, high, low, rips back up here, settles in, pulls back down for a higher low? I mean, is this it? Is this a V bottom in the Nikkei? I mean, we kind of had one right in here, didn't we? If we go to a smaller time frame, actually, you got to go to like a 1 hour chart. We had a cup and handle that I measured. If you watched my video from yesterday, we kind of did the same thing here in the Nikkei. We had this, very aggressive rip. I would say that we came kind of in this territory here. So no structure, pull back, and then broke that neckline, and then off we go. That move is probably close to full profit or full symmetry. So if I go from low to high, and we have a symmetry move, we did hit symmetry. If we go to this measured move above the highs, we're very close to it. So just like we're seeing in the U.S. markets, if we get back to this sell-off point, if the market finds this as a destination and then fades from there, that's what I'm looking to see. If the market just responds like it can't just go up forever, although it seems like it's trying to the last couple of weeks, but that would be a level that the market might hesitate. Also, a lot of previous support resistance, and this actually happened to be all-time highs from 34 years ago. Which we just broke it for the first time this year. The market got all excited. We also had all sorts of like over leveraging, in the Nikkei, and I'm sure borrowing trillions of yen to put it in the index, or trillions of yen that put it in Nvidia. And so there was like multiple layers of leverage that all kind of unwound here the last couple of weeks, which is this whole thing. Okay. Denise says, I'm not buying that the carry trade is 75% done. If we look at the levels where this carry started, we've barely retraced. Oh, I totally agree with you. I mean, as far as carry trade being unwound in full, there's so much lower to go. I mean, the dollar yen is kind of the proxy for, the carry trade and the unraveling. Let's go to the higher time frame here. I mean, look, this idea of a carry trade, this whole thing started in March of 2022 around 115. Okay. So look, I think that on the higher time frame, It's funny how this chart is like spot freaking on. But I just have so little interest in trading the Japanese yen. That's why I was long FXY, traded some Japanese yen futures. That was a lot easier. Made a few bucks. I also like pairs traded the yen crosses just to make sure if I was going to win one, win bigger. If I lost, I lost. But it was whatever. It wasn't the most enjoyable thing. I didn't make a ton of money. I made a couple $1,000 and call it a day. But look, it was a fantastic trade. It's just you're like, I don't know. It's like you trade the Japanese yen with both eyes open, and you can't sleep at night because it's like, what if it pulls back? Or putting a stop loss to break even. Sometimes it gets tapped every single time. But if you get a stop loss out there that you're up 100 plus pips, put the stop loss at break even, you might be rewarded for 1,000 plus pips, and that's precisely what happened. We dropped about 2,000 pips, right? So from 161 to 141, there's your 2,000 pip move. A lot of these yen crosses had roughly that. So as Denise said, I mean, this carry trade started to kick in during an FOMC piggyback move by the BOJ in March of 2022. I mean, we're not even close. We're not even close. I'd say this is maybe 50% done. And that's being generous, because if we go high, low, lower high, lower low, that puts us back into this region around 130, which isn't where this thing started at 115, but that would be a pretty successful unraveling, right? Because from there, we're coming back into major support. That was also where we had that little bit of intervention in late 2022 into early 2023 before the carry trade kicked off once again. So I look at that as, sure, we could have a 1, 2, 3 wave move, right? And maybe it's 5 waves. Maybe it's 1, 2, 3, 4, 5, and we come all the way back to this level here. But I'd say 130 to maybe 120 would be the big full. If we're 100% unwound, that's probably where it is, right? And I remember 120 because that was what I thought. There's no way it's going to go, from 113, 114 all the way to 120. I'm like, clearly I'm going to get a good sell trade from there. Boy, was I wrong, right? So I fought that thing like an idiot, got my money back, late 2022, early 2023. But what a stupid trade that was. Other than hedging, which I was, short against the dollar yen, but I was long Aussie yen, long euro yen, scalped my way back, and then fought through the yens, Swiss yen and dollar yen both had to fight through for most of 2022 like a fool, but it worked out okay. So yeah, I'd say 130 or lower would be the potential. Like, okay, we're officially unwound now, right? Which also means there could be more downside in the yen crosses, which also means there could be more risk off trading in the markets. There are factors with stronger yen that don't look good for the stock market, right? So all this talk of, ripping back to all-time high, I mean, maybe, but if we're going to see another leg lower in the Japanese yen, or another leg lower in the Nikkei, or just some volatility on the index, I don't know if we're just going to have like the US is on its own little island and nothing bothers it and there's no risk off trading. And I don't think that in 2 weeks the entire market just unwound and it's like, that's it. We're totally deleveraged. Everybody's clean. No harm done. I mean, it was a damaging event. Volatility wise, it was super, super frustrating. But I don't think it's necessarily done. Okay. So Gail, good point. Gail says, I agree with Denise. How low could it go? Well, that's my thought. I mean, if we're just going to measure the move, I could see, high to low, lower high to lower low. I like this kind of 129. I mean, if we just take the swing here, that actually is a 618 extension around 129. So call it a round number at 130, right? And we'll see if it actually does do that. From a daily time frame, maybe it's not as squeaky clean as that, but I do find it very interesting. Couple things here just to be noted. We pulled back to the 382, okay, which typically is not a shallow, or I'm sorry, it's not like the deep pullbacks that we like to see, like the 50 and 618 zones. But if we pull back to a 382, the scary thing about the 382 is if we are high, low, lower high, lower low, and this thing does not pull back again, okay? So let me just map this out. Here's kind of a price action 101 from what I've seen over the years. If this market is very, very motivated from a shallow retracement, then we're going after the 1618 all the way down here, which is 109, okay? So I could see this happening. If we have a really aggressive move, all of a sudden another big batch of risk-off trading, high, low, lower high, lower low. If we stay the course there, hit that 18127, and then reject off this low, we are likely going to reach that 618 and beyond. And that's where I think that 120 level or lower gets. We've got that target at 110 now. But we could also see price falling pulling back, right? I'm not quite convinced we can't pull back to 50618 pullbacks, but if we don't, if we go high, low, shallow, drop into that 18127, rip all the way back into this level, find a flat pattern, reject off the backside of this trend line, I still think this trade goes lower, right? So then I'd be looking at that 130 handle, maybe the 120 handle, trapping some profit in there. That would be good enough for me. I wouldn't need to be like, I'm crazy bearish on this thing. Look, if we have a chance to sell it now and get a stop loss in and we make fresh lows, trap that thing for some profit. If we rip back to the same levels and we have a flat pattern, get some confirmation, sell it with a stop loss above, get it at fresh lows, trap this thing, cancel, replace. I mean, that's the best you can do. And as always, we hope for the best, plan for the best, prepare for the worst. And if the Japanese yen gets us a good trade, then let's take it. Okay. So Denise, interesting. That'd be back to 2021 levels. Well, 109 would be back to 2021 levels, yes. But if we hit the the 130 handle or 120 handle, that's right within the wheelhouse of when this whole carry trade started. It was. I remember it because it was FOMC March of 2022. Okay, so right in here, when we were at like 115, 116, we had that huge break to the upside. It all started right there. So 115, 116 is where it all started. So if we come back to it, that's the official end of the move, right? We get to 109, yeah, we're talking about levels we haven't seen since 2020, 2021. But carry trade actually started in 2022. But I could see this level here, 127, 128, 130 is a round number. I could wrap my head around the Japanese yen doing that technically. Okay. All right. So that's the yen. That serves, all the yen crosses here. They could do very much the same thing. The dollar yen's a good proxy to look for. I still think there's some pullback levels here. Go to CAD yen, shallow pullback, but today it's interesting that the Japanese yen showing strength, yet the Nikkei was up. That is an odd correlation. We haven't seen that. When the yen was dumping, the Nikkei was dropping, the yen was super strong. The Nikkei has been ripping to the upside, and the Japanese yen has been weak. So maybe it's just a one-off thing for right now. Maybe we pull back a little bit deeper, and maybe the violence of the Japanese yen unraveling is a little bit lessened if we pull back into like the 50618 zones. But I would still look for that area to offer us some type of swing trade, right? And I will say this, the swing trade is not going to feel good. If we have a high, low, lower high, lower low, it's not going to feel good because remember, it's still negative swap. If you're holding Japanese yen strength, if you're holding, Aussie yen short, it is a negative swap trade. Your broker in Forex will charge you to hold that position. So you want fast volatility. You want nasty moves to the downside. You want it to be, quick. So that way you're not paying an arm and a leg in financing fees. Okay. Lewis says, in such a case with a strong yen, then what happens to the stock market? That's my point. It'd be risk off trading, wouldn't it? Okay. So I'll go back to this. If we start to see the Nikkei turning lower, if we start to see the Japanese yen turning higher, meaning Japanese yen strength, I could see this translating into some higher VIX. Now, do we go all the way back to 65? Probably not. But I could see the VIX going back up into the 20s, maybe into the 30s, right? That would be another wave of volatility. Where think about this. If we have this huge wave up, huge wave down, this is kind of a mean reverting instrument, isn't it? I mean, ultimately, the VIX tries to settle in at these lows in the teens, and the average historically is like 17. But couldn't we see some waves of volatility where it's not just up and down and done? I mean, we could see that, right? So yeah, I wonder if we do have this, like, expect some bigger swings in the markets. That's it. I mean, maybe that's the one thing this market just opened up is it's not just over. Now we're gonna have like waves of volatility, right? So that's what I'll be watching for. So what I'm going to be doing, so I talked about this a little bit this morning offline, but I'm going to be looking at some strategies that equities on demand students, we've taken these a couple of times. I'm kind of going back to an oldie but a goodie. I'm looking to look at some strategies that give me something like this. If I take a trade, it's going to be a debit trade, but I need about, if this is the SPX, for example, okay, I need about 50 points here, 50 points here. And if I can cover that 50-point move in a given week, this is kind of my dead zone, but I get up into these like profit peaks and then max out here. Okay. So I do have a dead zone. which would mean I take a loss, and that's if price goes absolutely nowhere. But in a given week, we're probably going to have 50 to 75 to 100 points one way or the other. Like right now, our SPX is probably moving close to 200 points a week, roughly. Maybe 150 points a week. So if we get a directional move of at least 50, that should be enough for me to generate some profit. And the nice thing is I've got 4 profit peaks. If we go too far outside these levels, I still get paid. So I make money here, max out profit at these peaks. And I can also hedge this position with a butterfly spread, which is a low cost entry. And that would be something like this. The butterfly spread would be risk here, and then peak profit, and then risk here. So this combination is, I mean, this is a fairly complex trade. This is going to be 8 legs for an options trade, and this is 3 legs, right? All that to basically say there's ways to make money week to week. But the issue is this is a debit, this is a debit. If I win on this one, okay, if I win on this one or win on this one, I need to make sure that it pays for my butterfly. And sometimes I need to make sure the math works out. Like break even's fine, but if this gets me profit, I need to make sure that I'm getting paid where I can, lose here, win here, make enough money to walk away. Lose here, win here, lose here, make enough money to walk away. The more trades I stack on, it just means that if I take 2 losses and 1 win, I need to make sure my wins are bigger, right? So anyway, just looking more like that over the next couple of months, just kind of campaign trades. That trade's good for me like every 1 to 2 weeks. All right. The weekly candle combination is so strong for indexes, still going to long in the short term. Well, I mean, yeah, the 2 candles for the last 2 weeks have been ridiculous. But like I said, if you checked out my video yesterday, look, I admit that this has been a ferocious comeback. Okay, this is the SPX. The last 2 weeks, so we finally ripped up here, had a green week, and we're probably on pace for one of the best weeks in a while, as far as the SPX goes. Okay, 4%. That's crazy high. 4% on the SPX. The NQs have come back in a big way as well. We have ripped up here on the Nasdaq. This run is around 6.3% from last week, and this week up another 5%. So yes, it's an impressive comeback. All right, and bigger picture. Let's talk bigger picture. Look, if you want to be a bear, and you're not getting this out of me. Like I'm not saying that we're going to go into some crazy downturn. Okay, if I'm going to see price stay supportive, look, I could see a little bit of stalling here. I could see some indecision. We pulled back 70% of that decline, which a lot of times 70% is a wedge. So I could see the market wedging over the next maybe 30 to 60 days. The bears would have to do this. To me on the SPX, the bears have to break below 5,300. If we break below 5,300, that shows they're a little bit more convincing with, maybe trying to revisit these lows. All right. But could we see the market, stalling here, pulling back to the trend line and then bouncing and then bouncing and bouncing and just waiting? Sure. And then the bears would have to break this or the bulls can break this. Okay. Seasonality wise, this is another thing that I keep going to. I know this market seems like it's nonstop trends, but if we go to seasonality and you go month to month, look at this on the 10-year, the 5-year, and this year. We are heading into September, October, which are historically really rough for the markets. Historically, September, October are the 2 worst performing months in the markets. Okay, so let this load. I'll go to SPX. Just give it a second. So, I mean, it was a big shakeout. I get it. Here we go. So as we head into September, October, okay, 10-year average for September is down 1%. 10-year average for October down 1.38%. 5-year average down 1.44, negative 0.68. So we're talking over the next stretch from a 5 and 10-year average, we're down on the 10-year average, we're down about 2.4%, actually 2.5%. So 10-year average is minus 2.5% between September and October. And on the 5-year average, we're down about 2%. So we're talking about, 2 to 2.5% down on average over the last decade. All right. So again, market can do whatever it wants, but historically speaking, there tends to be a lot of tax loss harvesting coming out of the summer. People are dumping bad positions. People are taking profits. People are washing trades, trying to thin out and concentrate the portfolio a little bit. But I don't think this is something to ignore. So could we? I mean, I'm just, this is completely hypothetical. If we ignore the seasonality here and we rip to all-time highs in September, October, something tells me that Q4 is going to suck. I mean, again, call it a hunch, call it intuition, but I would not be super confident that going into October, November, December, we're going to see a continued run. Or if it does, you're going to make me way more bearish going into 2025. But again, I'm not calling anything outside of, I'm just going to keep trading. Trade week to week, trade every month, trade my 30, 45, 60-day cycles, put up my campaign trades, try to generate some income. Doesn't have to be complicated, but we'll find out. Use trade size to my advantage, use the buying power that I have. It seems like right now it's like we're not that far away from these highs. In fact, we are now closer, right? We're way closer to the all-time highs right here than we are back at the lows that were scary, at that 10% drop. We're way closer. But the question is, can we get there? Right? So if we get there, very impressive recovery, but is this enough to sustain higher highs? We're going to find out. Okay. So how about this? I'm going to go ahead and wrap up the Pulver report and the YouTube session right now. And I'm going to jump in with A1 Trading and Nick and the team at 10 o'clock. So if you'd like to come in and start up another session with me, let's go ahead and do that. So let's pause the session here. We'll come right back in. So quick break, and we'll come right back at 10 a.m. Eastern time, and I'm going to push that through. I'll push it on YouTube and on Twitter. So this one, when I'm pushing this through Restream, I'm live on YouTube and Facebook and Twitter and LinkedIn and all over the place. And for everyone out there watching, I appreciate you watching. If it's something like YouTube, of course, like and subscribe and hit the thumbs up button, all that stuff, that really helps. Whether you're watching it live or watching the recording, but just give me a couple minutes here. We'll come back in about 3 minutes, and I'll jump in with A1 Trading, and we'll continue to unpack this stuff and keep the charts rolling, and also take some requests. I'm sure everyone wants to see gold, and gold and Ethereum are pretty interesting. I need to get a chance to take a look at those, so I'll do my top down a little bit more at the 10 o'clock session. Okay. All right. I'll see you in a couple minutes, and thanks for being here.